When someone sells Bitcoin at a loss, the feeling is painful and usually kept private socially. But regardless of how you feel, the chain keeps a public receipt anyway. Over this past weekend, an on-chain analyst who writes under the name Darkfost published a note through CryptoQuant that caught attention because of what it measured, not because of what it promised. The ratio of unspent transaction outputs spent in profit versus spent at a loss has fallen to its lowest level of this bear market cycle. That is the first time this specific signal has fired since the correction began. What that means is more coins are leaving wallets underwater than leaving wallets in the green. Bitcoin traded near $60,000 through a quiet weekend. The chart looked almost still, but underneath, holders were locking in losses on the ledger, and the chain counted every one. Every Bitcoin you hold is really an output from an older transaction that nobody has spent yet. Think of each one as a labeled coin in a jar. The label says how much is inside and which address owns it. When you pay someone, you do not edit the label. You spend one or more of those coins, and the network creates new labeled coins for the recipient and for any change coming back to you. That is the unspent transaction output model Satoshi described in the original software. It is not a metaphor. It is how ownership is represented on the ledger. And because each output carries its history, the network can ask a simple question whenever coins move. Did this spend happen above or below what the holder likely paid? Researchers built several gauges on top of that idea over the years. One of the better known gauges is something called Spent Output Profit Ratio, or SOPR. It compares the price coins moved at today to the price they last moved at before. When SOPR sits below 1, the average spend is a loss, and when it sits above 1, the average spend is a profit. Darkfost's profit versus loss UTXO count is a cousin of that family, counting outputs rather than averaging a ratio. But the intuition is the same. The chain is keeping score. Darkfost's Saturday note focused on that question at scale. When the profit versus loss ratio collapses, it means capitulation in the mechanical sense. Holders who bought higher are finally spending at lower prices. The analyst wrote that this is the first time the signal has triggered in the current correction, and that it reflects a broader washout beginning, not a one-day glitch. The last time the same kind of read got this stretched was in the depths of the prior bear market in 2023, when spot traded near $26,000. Analysts on social media who track the metric noted that it has caught cycle lows since 2016. That history is why the signal travels fast. It does not mean the bottom is in, but it means the ledger is recording pain at a level this cycle had not reached until now. Other on-chain shops framed the same weekend differently. One firm said Bitcoin has likely moved past the initial breakdown, but is still in a base formation phase, meaning the market may be clearing weak hands without the kind of high-volume panic that marked the 2022 washout. Another analyst argued that the final bottom is not here yet, and pointed to chart patterns targeting the mid-50s. The disagreement is normal. The shared fact is that loss-taking on-chain has intensified. Short-term holders, wallets that acquired coins recently, have been the main source of exchange inflows in this stretch. That matters because recent buyers feel drawdowns first. When spot falls from the $65,000 area toward $58,000, the coins most likely to hit exchanges at a loss are the ones that arrived last month, not the ones that arrived 5 years ago. Set against fiat markets, the asymmetry is quiet. A brokerage statement can hide who sold at a loss until quarter end. Bitcoin's ledger updates in real time. There is no closing bell on the chain. Every spend is visible to anyone running the math. For a long-term holder, the signal is not a buy button. It is a stress gauge on the holder base. Capitulation describes what happens when marginal owners decide they cannot hold drawdown anymore. That decision shows up as red on-chain metrics long before it shows up in a comfortable headline. The network does not care whether the seller is capitulating. It only records the spend, validates the signature, and moves on to the next block. The macro backdrop this month has been heavy. US spot Bitcoin ETF outflows, a strong dollar, corporate treasury stocks under pressure. But those are separate threads from the UTXO read. The on-chain signal says the selling is now reaching holders who are locking in losses, not just rotating winners. Blocks still arrive on the 10-minute cadence the code has kept since 2009. The 21 million coin cap is unchanged. What shifted over the weekend is the composition of spends. More outputs crossing the line from profit to loss in a single day than this cycle had seen before. The chain did not pause to ask why. It counted, validated, and appended. That is the engineering point. Capitulation is an emotional word for a bookkeeping fact. The ledger is neutral. It lists who moved coins and at what prices relative to history. Feelings belong to the holders. The protocol keeps the receipt. Does a cycle low UTXO profit-loss ratio mean the bottom is in? It does not. What it means is loss taking has reached a level this correction had not printed until Saturday. Bottoms in past cycles also felt terrible for weeks after similar signals. Comfortable entries rarely coincide with metrics that measure pain. How is this different from watching the price chart? Well, price tells you where the last trade cleared. UTXO profit loss tells you whether coins moving now are mostly winners or losers from the holder's point of entry. You can have a flat price with rising loss taking if older holders are quietly distributing. Is this the same as minor capitulation? No, different layer. Minor capitulation is about hash power leaving when electricity economics fail. Holder capitulation is about coins leaving wallets when human holders decide the drawdown is too much. Both can happen in the same month, as they did in June, but they measure different parts of the stack. So why do short-term holders matter so much here? Because they have the least history with the asset and the tightest pain threshold. When they feed exchanges at a loss, the on-chain ratio moves fast. Long-term holders can absorb a drawdown without spending at all, which is why some analysts say the market can look capitulated on one metric and still not show 2022-style panic volume. So if ETF outflows continue, does that override the UTXO signal? ETF flows move coins inside regulated wrappers. On-chain loss-taking can come from self-custodied coins too. The signals can reinforce each other in a weak month, but they are not the same measurement. Should long-term holders change behavior when this signal fires? That is a personal question this piece will not answer. Structurally, the signal tells you stress is present in the holder base. It does not tell you how long stress lasts. Past cycles show both sharp reversals and long sideways periods after similar reads. So just to recap, more output spent at a loss than at a profit, at a cycle low, recorded on the ledger this past weekend. Thanks so much for joining us today. Really appreciate your time. The channel will keep tracking whether the UTXO ratio stays depressed, how short-term holder flows evolve. Subscribe and hit the bell to stay in the loop. Take care, everyone. Talk soon.